Another election has come and gone. The outcome is still undecided, with some states that haven't yet been called. But regardless of who the president is, the real winner is the state. We can expect continued fiscal stimulus, meaning that regular people will lose more of their savings as money printers run through the night. In the past 12 months, the amount of US dollars in existence rose by over 41%, the fastest rate of growth by far in 60 years. US Treasury debt held by the public, including foreign governments such as China and Japan, is now greater than gross domestic product for the first time since the end of World War II. When World War II ended, the debt to GDP ratio fell, but with today's welfare warfare state, the nonpartisan Congressional Budget Office anticipates no end in sight. This year, the Federal Reserve has pumped more than $3 trillion of freshly printed money into the economy. Let me put it another way. 25% of all money ever created by the Fed was created in the last 12 months. If Biden wins, he has pledged at least another $5 trillion of new government spending, and we can expect the Fed to continue to print money to finance this. What does this mean for Bitcoin?
I'm a Bitcoin bear and I'm scaring the status quo. Got that crypto going and that file upload in the algo.
Today, Bitcoin hit $15,000 for the first time in almost 3 years. People are pouring their money into it. Many large companies publicly admitted they're doing this in order to safeguard their wealth. Earlier this year, MicroStrategy made Bitcoin their primary reserve asset, investing a total of $425 million, saying that it's a good hedge against inflation. Square put 1% of their net worth into Bitcoin, totaling $50 million. Mode Global Holdings announced plans to make a significant purchase of Bitcoin as part of its treasury investment strategy, and they're a London Stock Exchange listed company. The threat of inflation is having global consequences. Fed Chair Jerome Powell had a 2-day meeting this week, but things are expected to stay pretty much the same, which, as announced in August, would be a flexible form of average inflation targeting. This means that the Fed isn't going to stop printing money even if prices rise above 2%, because it'll all average out in the end. Powell never specified what time period the inflation would be averaged out across, so your guess is as good as mine. It's nice to have movable targets like this because then no one can ever hold you accountable. So is Bitcoin gaining value, or are our US dollars losing value? Well, it's both. When the money supply is diluted, everyone's savings lose value. But at the same time, people are realizing the value of having a money that isn't at the whim of politicians and stimulus policies. Many people are predicting a crash and hyperinflation, but the real question is, when will this occur? Some doomsayers think it could be any day, but even economist Gene Epstein, who's usually quite conservative on these predictions, thinks that it could happen in the next 10 years, which is why he adds to his portfolio every month $1,000 worth of gold and $1,000 worth of Bitcoin. Much like this election, the timing of this impending financial collapse is too close to call. But we do already know who the winners will be, those who understand how to use Bitcoin and other decentralized cryptocurrencies. Today's Cointree comment highlight comes from Kurt, who said, "Just a small token of gratitude. A huge thank you, Kurt, for your support. To have a comment or question read on the show, add a message to my wall at cointree.app/Naomi Brockwell. For a weekly roundup of crypto news summarized in under 5 minutes directly to your inbox, sign up to my cryptobeat newsletter at naomibrockwell.com/cryptobeat. Please also check out my members-only newsletter where you get exclusive videos and all kinds of other perks. Don't forget to like this video before you go, subscribe to the channel, share it around. It really helps my channel grow. Thank you so much for your support, and thank you for watching.